So you can actually see that both ways, and I think it's important to take a balanced view here. Now, with this context, what is actually the evolution of the product offering in the countries affected by low rates? And I'm going to give detailed examples for Germany and for Switzerland. Now, this is, I promise, the most complex picture you will see in the presentation. Let me try to actually explain it. So, what we have here is we have different types of products, and we have classified them along two axes. So the first axis, the vertical axis, is the level of market exposure versus guarantees. So at the bottom of the page are the guaranteed products. And the second axis, the horizontal axis, is the degree of complexity. So the products to the right become more and more complex. And then you have the little flags around the product, which basically say in which country do we offer which product. Now, if we go to the left of the chart, you see, let's say, the products that everybody knows. So top left, the pure unit-linked product exists in every country, is offered by everyone basically in every country. Bottom left, the opposite, the traditional savings product with a guaranteed interest rate, also offered by everyone in every country. Now, there are two trends that we observe and that we're working on, two directions. So the first direction is actually coming from the top, saying that, okay, how can we make the pure unit-linked product more attractive to customers that want some exposure to capital markets, they want some exposure to equities, but they are not comfortable actually taking the full risk, which is in most European countries still the majority of the customers. So how can we add some guarantees to increase the appeal to broader customer groups? Or it might not have to be guarantees, but some soft protection level at least. So that's the first direction. The second direction, coming from the bottom, is how can we make the traditional product a bit more bearable, reducing the capital intensity so that it's actually still possible to offer them in the current environment. So most of the action is in the middle. So what we see here is, and I'm just going to pick, let's say, some. We see hybrids of unit-linked and traditional. They also exist in Spain. So you basically say 50% of the customer's money goes into a traditional product and 50% goes into a unit-linked. Very simple. And then you can make that, of course, tailored to the customer. It doesn't have to be 50-50. It can be 75-25 or 25-75. And the customer can choose on the unit-linked part the funds that the customer wants. So that's one which is still relatively simple. Then moving, let's say, more to the right, there are more complex things. So there are, at the bottom, the new traditional with index participation. That's, I'm going to explain in more detail a bit later, is basically a traditional product with a guarantee of 0 and an upside linked to some stock index, which is manufactured through derivatives. Or at the top, it's protected unit-linked products with an index participation. So of course we can do unit-linked products that say there is an 80% floor, you can never lose more than 20% of what you put in. And then in the middle, there's the CPPI product, or the individual CPPI product, which is a dynamic strategy that is shifting between a so-called performance asset with equity exposure and a protected asset, which is typically a money market fund, also creating a floor in the performance. Now, two additional things I would like to point out. So first of all, you see that there are two products on the right-hand side, the variable annuity and the dynamic hybrid. There are no flags in it. So we believe that those complex products are not necessarily, that's our experience, what really works with distribution. So we are, for example, we stay out on purpose on variable annuities because in our experience, it's felt a big challenge actually to make it work. And then second thing I'd like to point out, I mean, if we look at the different flags and what could be actually the kind of the next frontier for Spain, it would be those in the middle. So the protected unit linked as well as the new traditional with index participation. Now, let me go into a practical example. That's the German market. Now, the German market has seen actually a lot of innovation in the last 5 years. Not because Germans are terribly innovative, because they are not, but because interest rates have just been already quite low for a long time, and therefore the industry has been really under pressure to move. On the other hand, what is difficult in the German market, Germans are, I don't want to have too many national stereotypes, but in generally conservative. So Germany is not a unit-linked market. Germans want a guarantee. 75% of customers, that's what market research shows, still want a guarantee, even if it's a low guarantee. That's the customer need. So the challenge is how to bring a product to the market that has a guarantee, but that works in the current interest rate environment. And the types of products we've seen, it's some of them we've seen also on the previous page. It's these traditionals with index linkage. It's hybrids. Germany is the market for hybrids. So there are hybrids with, let's say, 2 different baskets, hybrids with 3 different baskets, hybrids that are static, hybrids that are dynamic. It is essentially always a combination of a traditional component and a unit-linked component that are in the dynamic variants shifted around, and the static variants are just fixed. We've also seen variable annuities. They've remained a niche in the German market, and what we have concentrated on, that's our flagship product, is the unit-linked CPPI, and that's explained on the next page. So what is it? It's actually a product we do together with Deutsche Bank. So the main distribution channel is the Deutsche Bank branches. It requires, let's say, a distribution channel with some closeness to investment products. It would not be, we sell it via agents, but it's typically not a product that is very well suited to an agent channel. The way it works is it has 2 components. On the left-hand side, it has equity funds, and on the right-hand side, it has fixed income funds. It's a pure unit-linked product, and the product is shifted daily between the 2 funds according to the CPPI algorithm. CPPI algorithm stands for Constant Proportion Portfolio Insurance. So what the product does is when equity markets go well, it will allocate more to equity. When equity markets don't go well, it will allocate more to fixed income. And through that, it gives a hard floor to the customer. So the customer at the end of the duration has the guarantee to get at least their premium that they paid in back. And in this case, the guarantee is given not by us, but it's given by the bank, by DWS. What the customer can also do is every 5 years they can lock in the maximum value, and there's all kinds of protection riders like disability that they can buy. This has been successful because it's basically the message to the customer is here you have equity exposure, which is great in the current interest rate environment where, I mean, bonds, fixed income doesn't return anything, but there is a controlled risk. You never lose what you put in. So that's one of the examples for Germany. Switzerland, you could say it's even a bit worse in terms of interest rates. So that's the country with the lowest interest rates in Europe. The specific thing about Switzerland is there is a very extensive Pillar 2. So people are covered through Pillar 2. And that's why the Pillar 3 is largely discretionary. It's saved on top. And people are therefore can afford to take a bit more risk on their Pillar 3 compared to Germany. And they are therefore a bit more receptive to unit-linked products. What works best in Switzerland, I mean, is those new traditionals, which is basically traditional products with variable interest rates using certain formulas, as well as the traditionals with index linkage. So, and that's a product that we have, and I'm going to explain on the next page. So, Basically, the product has a couple of different components. Most of the premium is invested